Hello, today I want to talk about corporate earnings. If you're a CFA charter holder like myself, you learn that company fundamentals like revenues and especially earnings drive company value. I'm sure you've heard and seen other sources that say the same thing. Today, I want to look at the data and see if this is actually true. That makes perfect sense on the surface. You're a company, your earnings are growing, your company value should grow along with your ability to generate these after-tax profits. Now, if we look at the data, however, it's not crystal clear here. This is a chart rolling S&P 500 returns, rolling earnings on a 5-year basis. We do see periods in here where they do seem to be moving in lockstep, but there are also periods in here when they're extremely disconnected from each other. One's going up, one's going down. This is 5-year rolling. You can also look at this at rolling 1-year numbers. You can look at this rolling 10-year numbers. We can take those nominal returns, convert them to real returns. Any way we slice and dice it, the correlation between the two is very low. It's essentially zero. Now we can look at this also kind of on a decade by decade basis. There seems to be some correlation here, but we see something like in the 2000s, we saw annual profit growth of 10.3%. And yet for the entire decade, the returns for the index were negative 1%. On the flip side, we see in the 2010s, annual profit growth of 1.5% and pretty nice returns of 12.8%. Here's another chart where we're going to kind of break it down into quintiles. It's a little bit confusing how this chart is read. So let me just point out here that the S&P 500 returns are the bars here, these returns here, and the year-over-year earnings growth are the numbers at the bottom here. But the big takeaway here is when earnings growth is low, bad, negative 25% to negative 10%, that's when the S&P 500 does its best. On the flip side, we see that when earnings growth is really, really nice, 20% or higher, that the S&P barely has positive returns. Yes, on the far side of the chart, we do see that when things are terrible, earnings growth is really, really low, less than negative 25%. The returns on the index are also pretty poor. Now you're saying, hey, Brian, everything you've shown me so far is looking back at earnings. And what really matters is what is going to happen in the future here. So in this particular example, what we've done is we've given you as an investor perfect foresight. You know exactly what earnings growth are going to be in the future. And again, we don't really see much here. All we see kind of is the only time that the S&P 500 has negative returns is in this worst, perfect forecast growth scenario. And other times it doesn't really make sense. Though the S&P always seems to be up, and it's up most in kind of these middle deciles, not these super high growth periods, kind of like we saw in the previous chart. Now you might say, well, there's expectations, there's the future, but what if you do better than everyone's thinking? Well, it turns out that doesn't really answer the question either. If you go back to 1996 and you look at every single quarter since then, 60% of the time the S&P is down. It also has earnings beats at the same time. Now, if you go back and remove that whole financial crisis period, you take that out of the equation, then 75% of the time the market was down in a quarter, the earnings beats were also there, right? In fact, if you go to 2000, we saw this where 10 consecutive quarters we had earnings beats, and yet every single quarter, 4 consecutive quarters in 2000, we saw negative S&P 500 returns. Now, finally, there is this, it's one of my favorite charts. I have shown it in some other videos where we look at corporate profits and we look at the price of the S&P 500. And we can see here, there are times when these things are moving in lockstep, but there are periods, namely the internet bubble and right now, where there's a massive disconnect between the two, where the price just doesn't seem to match corporate profits. There are some nice places in here where you see the opposite, where the S&P is cheaper than the corporate profits might suggest, but never to the extremes that we see during the internet bubble and currently. That's it for today. Happy trading out there. Please hit subscribe. Please hit like. It really does matter. My name is Brian Kozlowski. Thank you so much.